Hello everybody, my name is Mr. Fossil, this is Business 101. Today we're going to be going over the sources of finance for GCSE AQA exam board. So businesses need to consider how they will fund their activities when starting up, as well as during their day-to-day operations. Various costs need to be covered, such as equipment, stock, and paying bills. Short-term finance is used to help business maintain a positive cash flow. For example, it can be used to get through periods when cash flow is poor for seasonal reasons, bridge the gap when a large payment is delayed, leaving the business without enough money to pay its bills, and provide extra cash to pay for the manufacturing required to meet sudden or unexpected changes in customer orders. Overdrafts are one of the most common forms of finance. However, they should be used carefully and only in emergencies, as they can become expensive due to the high interest rates charged by banks. Common features of a bank overdraft include variable interest rates, so the cost of borrowing money will change when the interest rate changes. Flexibility, a business uses its overdraft only when it needs to. Therefore, the business will only pay interest when the overdraft is used. And the bank can demand full payment. So, banks can demand full repayment of an overdraft within 24 hours. Trade credit must be agreed with a supplier and forms a credit agreement with them. This source of finance allows a business to obtain raw materials and stock, but pay for them at a later date. The payment is usually made once the business has had an opportunity to convert the raw materials and stock into products, sell them to its customers, and receive payment. Common terms and conditions of a credit agreement include a credit limit, so this is the maximum amount of credit available to the business, a credit period, so the length of time the business must pay what is owed, usually 30, 60, or 90 days, frequency of payment, so how often payment is required, usually monthly, the method of payment, which is the way in which the business makes payment, so bank transfer, check, or card payment, and retrospective discount. So this is a discount given when the business has purchased a certain amount of stock or raw materials. Long-term finance. So these are things such as personal savings, venture capital, share capital, bank loans, retained profits, and crowdfunding. Personal savings are money that has been saved up by an entrepreneur. This source of finance does not cost the business, and there are no interest charges applied because these are personal savings. Venture capital is money invested by an individual or group that is willing to take the risk of funding a new business in exchange for an agreed share of the profits. The venture capitalist will want a return on their investment, as well as input into how the business is run. Share capital is money raised by shareholders through the sale of ordinary shares. Buying shares gives the buyer part ownership of the business and therefore certain rights, such as the right to vote on changes to the business. This can slow down decision-making processes. Advantages of share capital include share capital is a source of permanent capital, so shareholders cannot have a refund on their shares. Instead, if they want to sell their shares, they must find someone else to sell them to. And there are no dividends to be paid if the business has a poor year. Shareholders are not promised dividends every year, as dividends are only paid if the business has made sufficient money to pay all its costs. So, what are the disadvantages of share capital? Well, these include the fact that it dilutes control for the founders. The more shares that are issued, the more shareholders there are who own part of the business. This results in the founders having less control. In order to have majority stake in the business, The founders must hold more than 50% of the shares, and the business is vulnerable to takeover. So, as a business grows and sells more shares, it becomes vulnerable to the threat of a takeover. This is because the shares are sold publicly, and if an individual or group buys enough shares, they can persuade other shareholders to vote for a new management team. A bank loan is money lent to an individual or business that is paid off with interest over an agreed period of time. Usually, this rate of interest is fixed. This means that the business knows in advance what the cost of borrowing will be and what monthly repayments will be required of them. This allows the business to plan ahead. To get a bank loan, a business must apply to a bank. The bank then carries out credit checks to see the financial history and reliability of the applicant. The bank may require the business to secure its assets against the loan. This means that if the business is unable to repay the loan, the bank can demand the sale of the assets to raise money to pay back the loan. If a business does not have enough assets, a bank may require a guarantor to repay the loan if the business does not make its repayments on time. And just to quickly mention, a guarantor is a third party who signs up to essentially pay off any debt that the main individual cannot physically afford to pay. And if we quickly look at these formulas at the bottom, this is for calculating interest and calculating the rate of interest. So when it comes to calculating interest, this is total repayment minus borrowed amount. And when it comes to calculating the rate of interest, this is total interest divided by borrowed amount times 100. And that will give you the rate of interest. Retained profit is when a business makes a profit. It can leave some or all of this money in the business and reinvest it in order to expand. This source of finance does not incur interest charges or require the payment of dividends, which can make it a desirable source of finance. Crowdfunding. So, crowdfunding involves many people investing small amounts of money into a business, usually online. Commonly used crowdfunding websites include Crowdfunder, GoFundMe, and Kickstarter. Advantages of crowdfunding include the fact that it acts as a form of market research. If people don't invest, it means the business idea is not attractive or distinctive enough, indicating that the business is likely to fail anyway. And it provides opportunities for individuals to start up a business even if they don't have access to other sources of finance. So what are the disadvantages? Well, the disadvantages are the business must be interesting. Crowdfunding is most successful when the business idea is appealing, interesting, and innovative. It can be difficult to reach the funding target. Statistics from crowdfunding websites indicate that less than 33% of businesses achieve their funding target, so it's not the most reliable way to source funding. And that is sources of finance. I hope everybody learned something from this video. Please do leave a comment in the comment section if you have any questions. Leave a like on the video if this helped you, and subscribe to the channel for more videos coming in the future. Thank you so much for watching, everybody. Goodbye.